All right, let's talk about something that could be a complete game changer for the right business owner. We're diving into a tax strategy that could be worth hundreds of thousands of dollars. We're going to look at how Canadian sole proprietors, that's right, sole proprietors, can potentially tap into this super valuable Lifetime Capital Gains Exemption, or LCGE. Now, a lot of people think this is just a tool for corporations, but what if it wasn't? Let's break down how you might be able to save a fortune in taxes when you sell your business. Now, to really get how this all works and see just how big of a deal this can be, we're going to walk through a pretty detailed case study. This isn't just about theory, you know? We're going to put some real numbers to it so you can see how what seems like a small change in your business structure can have an absolutely massive impact on your bank account. It really helps to see the theory in action. So, I want you to imagine this. You've spent years, maybe decades, building a successful business from the ground up. It's unincorporated, it's your life's work. And then an offer lands on your desk for $1.2 million. I mean, this is a life-changing moment. But almost immediately, it brings up a huge question. How much of that $1.2 million do you actually get to keep? And that very question gets us right to the heart of the problem for every sole proprietor thinking about selling. You see, the way your business is legally set up, that directly controls what happens at tax time. And honestly, if you're a proprietorship, the initial news isn't great. So that $1.2 million number, that's what we're focused on. It represents the value of everything you're selling, the goodwill, the equipment, all of it. Now, without some really careful planning, a huge chunk of this is going straight to the tax man. For a capital gain this big, you could easily be looking at a tax bill around $300,000. Think about that. That's a quarter of your sale price. Just gone. Here's the most important point to get. As a sole proprietor, you and your business are legally the exact same thing. There's no separation. You don't own shares in your business. You personally own the assets of the business. So when you sell, you're actually selling off those individual assets. And from a tax point of view, that means the entire capital gain just flows right onto your personal tax return. Which leads us to the million-dollar question, or in this case, the $1.2 million question: can a sole proprietorship even qualify for the Lifetime Capital Gains Exemption? And the simple, direct answer is no. At least not on its own. The exemption is written specifically for the sale of shares, not the sale of business assets. Okay, so to really understand why this difference between assets and shares is so incredibly important, let's look at what could be. Let's compare this tough reality with the ideal scenario. What if you could use the exemption? Well, the difference in what you walk away with is pretty staggering. What's so powerful about this slide is just how different these two paths are. On the left, you've got the proprietorship sale, where the whole $1.2 million gain is on the table for taxes. But on the right, that's the goal. That's what happens when you sell shares of what's called a Qualified Small Business Corporation, or QSBC. It's a fancy name, but it's basically a specific type of Canadian corporation that meets certain tests. And selling its shares, that's the key that unlocks this whole amazing tax advantage. And this number right here, this is why we're talking about all of this. The LCGE gives you this massive exemption on capital gains when you sell those QSBC shares. The actual number goes up with inflation. It's over $1 million now, but let's just stick with a conservative $800,000 for our example. Remember that $300,000 tax bill we talked about? Well, with this exemption, your taxable gain plummets from $1.2 million down to just $400,000. Your tax bill could drop to around $100,000. That's a potential savings of $200,000 in your pocket. That is the prize. So, of course, this leads us to the big question. If a front door is closed to a sole proprietor, is there a side door? Is there a legal, legitimate way to make this work? You might be thinking it's too late if you've already gotten an offer, but the answer, believe it or not, is often a surprising yes. And this is where things get really clever. The solution is all about changing what you're actually selling. It involves a smart, proactive, and completely legal restructuring of your business before you finalize that sale. The process is really a three-step play. First, you incorporate a brand new company. Simple enough. Second, and listen, this part is absolutely critical. You transfer the assets from your sole proprietorship into this new corporation. You do it using a special rule called a tax-deferred rollover. This lets you move everything over without triggering immediate taxes. And then finally, you sell the shares of this new company to the buyer. And just like that, you've totally transformed the deal from a taxable sale of assets to a potentially tax-exempt sale of shares. Now, anyone who knows a little bit about tax law is probably waving a red flag right about now. Because there's a pretty famous rule that says to get the LCGE, you have to have owned the shares for at least 24 months before the sale. So how on earth can these brand new shares that you've only owned for a little while possibly qualify? This brings us to a really elegant little piece of the tax code. It's the exception to the rule, and it's the key that makes this whole strategy work. It's something called the deeming rule. So what is this deeming rule? Well, it basically lets you look back in time. For that 24-month test, the rule says that your new shares are deemed to have been owned by you for the whole time you owned the assets in your old proprietorship. It kind of tacks on your old ownership history to your new shares. It's a beautiful solution to the holding period problem. But, and this is a big but, this powerful rule has some very strict conditions. You have to get this right. First, you can't just pick and choose which assets to move. You have to transfer all or substantially all, which the CRA usually sees as 90% or more of the value of your proprietorship's assets into the new corporation. Second, this benefit is personal. It only applies to you, the person who was the original sole proprietor. That second condition, the fact that the benefit is personal, leads us to our final and really important point. There's a major limitation on how you can use this exemption, especially when family is involved. So the bottom line is this: you can't use this strategy to split the tax benefit. For example, you can't just incorporate the new company, issue a bunch of shares to your spouse, and then have them also claim their own LCGE on the sale. The special magic of the deeming rule doesn't extend to them or any other family member you bring in at the 11th hour. This table really says it all perfectly. The sole proprietor, the one who owned the assets from the start, yes, they get the green light. The deeming rule applies, and they can claim the LCGE. But a spouse, who only becomes a shareholder during the incorporation process, nope, they don't get the benefit of the rule for this purpose. So they can't claim the exemption on this deal. And that brings us to our key takeaway. The Lifetime Capital Gains Exemption is not out of reach for a sole proprietor. It's really not. But you need the right professional advice, and most importantly, you have to do this proactive planning before a sale is finalized. With the right structure in place, it's often possible to take full advantage of this incredible tax break. So, this leaves us with one final thought for every single business owner out there. The value you build in your business is one thing, but the value you actually get to keep is something else entirely. It is so important to ask yourself, is my business structured right now for a tax-efficient exit down the road? I really hope this explainer has given you some valuable things to think about.